Imagine you walk into a coffee shop.
Okay.
You order just a standard cup of coffee, right?
Right.
And the barista slides your drink across the counter and says, congratulations, here's your coffee. And by the way, you are now a part owner of this entire coffee company.
I mean, you would look at them like they were completely crazy.
Right. Because that is just not how standard commerce works.
No, not at all.
Usually, you are simply the consumer,
Yeah.
and someone else, like a founder, a venture capitalist, a group of shareholders, they hold the ownership.
Exactly. They take the risk. They own the company.
But what if I told you there is a massive, like multi-billion-dollar sector of the financial world where this exact scenario happens every single day?
It's pretty wild when you actually think about it.
It really is. So today we are unpacking a simple but entirely game-changing question that every insurance professional and CPCU candidate really needs to know, which is who actually owns the insurance company?
Yeah, and it's a question that sounds deceptively simple on the surface, honestly.
But it changes everything, right? So whether you are studying for your professional designations, maybe catching up on industry mechanics, or you're just, an insanely curious learner trying to understand the hidden gears of the financial world, this custom-tailored deep dive is going to fundamentally change how you look at the business of risk.
It really alters everything about how certain institutions operate in the free market, because we are talking about the concept of the mutual insurance company.
The mutual company.
Right. And looking at your coffee shop scenario, it is a model where the moment you purchase a policy, like the exact moment you hand over your premium to become a customer, you literally become an owner.
It sounds like a gimmick.
It does. It sounds like a quirky fringe business model or, I don't know, a clever marketing campaign dreamed up by an ad agency. But it's not. It is a foundational structural mechanism.
So it actually dictates how the business runs.
Oh, entirely.
Yeah.
The ownership model dictates how these companies price their products, how they negotiate claims, and how they secure their long-term survival in an incredibly volatile industry.
Okay, let's unpack this. Because before we can understand how these mutual companies completely upend the traditional insurance market, we really have to define what they are.
Right, the basics.
Yeah, and more importantly, where the power lies. Because I can hear you, the listener, right now saying, wait, a multi-billion-dollar financial institution where the customers call the shots.
It sounds like a nonprofit charity.
Exactly. It sounds like a charity, not a competitive corporation.
Yeah.
So how is that actually sustainable? Break down the textbook, CPCU-style definition for us. What makes a mutual company a mutual company?
So at its absolute core, a mutual insurer is an insurance company owned entirely by its policyholders. Entirely. That is the singular defining characteristic. There are absolutely no outside shareholders.
Wow. Zero.
Zero. No activist investors sitting on Wall Street pulling the strings. No private equity firms demanding, aggressive growth. The policyholders occupy this really unique dual role.
Meaning they're the customer and the boss.
Exactly. They are both the consumers of the product and the owners of the enterprise. And because of that unique dual role, the company's primary fiduciary purpose shifts dramatically.
How so?
Well, instead of existing to maximize profit margins for outside investors, a mutual company exists to provide insurance protection at a reasonable cost to its members.
I love the memory trick for this from our sources, by the way, because it makes a highly abstract financial concept very, very concrete.
The housing one.
Yeah, the housing cooperative. So if you're trying to visualize this, think of a housing co-op.
Yeah.
In a standard apartment building, you have a landlord or a real estate conglomerate who owns the building, right?
Yeah.
You just pay rent.
Right, you're just a tenant.
Yeah.
Yeah.
And if the landlord can cut corners on maintenance to squeeze out a bit more profit, they probably will.
Usually, yeah.
But in a housing co-op, everyone who lives in the building owns a share of the building itself. You all have a vested interest in keeping the roof from leaking and the boiler running efficiently, because it's your building.
It's your asset.
Exactly. In a mutual company, the equation is exactly that simple. Buy a policy, become an owner. Mutual equals members own it.
And that contrast becomes incredibly sharp when you place that model next to its primary alternative, which is the stock insurance company.
Right, the big guys we usually think of.
Yeah, most of the massive global corporations we interact with daily operate as stock companies. They are owned by shareholders, they're often publicly traded on a stock exchange, and their operational compass points in a completely different direction.
Toward profits.
Right. In the stock model, the primary legal and fiduciary responsibility of the company's management team is to maximize shareholder value.
That's their legal job.
It is. The profits belong to the investors, and those investors receive dividends based on the company's quarterly financial success. But a mutual company has no public stock, which means their focus remains entirely on long-term stability and cost efficiency for the policyholders.
But wait, doesn't that make them inherently slower and, less competitive?
What do you mean?
Well, if there are no outside investors constantly demanding quarterly profits, no analysts scrutinizing their earnings calls every 3 months, how does that actually change the vibe in the day-to-day operations?
I see.
Without Wall Street breathing down the CEO's neck to hit a growth target, do they just become stagnant? Does the lack of pressure make them better insurers or just lazier?
It's a great question. It doesn't make them stagnant, but it makes them fundamentally different in how they approach risk and reward. The absence of that external pressure creates a massive domino effect across every operational department, starting with underwriting.
Okay, underwriting. Let's talk about that.
Right. Underwriting is the engine room of an insurance company. It is the process of evaluating risk and deciding whether to actually insure it.
So deciding who gets a policy and who doesn't.
Exactly. Now, picture a stock company under intense pressure. The CEO is on an earnings call, premium growth is down 2%, and the Wall Street analysts are just hammering them.
Sweating bullets.
Totally. So there is a very real temptation to aggressively expand, to maybe accept slightly riskier policies, or to loosen underwriting standards just to get more cash in the door before the quarter ends.
Just to make the spreadsheet look good for the investors.
Right. But mutual insurers don't have that artificial timeline. They heavily emphasize long-term underwriting discipline. They don't need to chase volatile, high-risk growth just to satisfy an analyst.
So they can be picky.
Very picky. They are playing a 50-year game, not a 3-month game.
Wow. Okay, so they aren't chasing a quick buck because there's literally no one to give that quick buck to. They just want to make sure the co-op doesn't burn down.
Exactly. And that mindset directly dictates how they price their policies, too.
The premiums.
Yeah. A stock company generally wants to maximize its profit margins to increase the stock price. But a mutual company seeks to charge what the industry calls adequate premiums.
Adequate. Not maximum, adequate.
Right. They want to collect precisely enough money to pay anticipated claims, cover their internal operating expenses, and maintain a healthy financial safety net.
And that's it.
That's it. If they execute that perfectly, they have no incentive to squeeze an extra 10% out of the customer. Their mandate is sustainable pricing for the people who actually own the company.
Which completely flips the script on the claims department too, right?
Oh, absolutely.
Because if I'm a stock company, there is a natural inherent tension there.
Yeah.
Every single dollar I pay out in a claim to a customer is a dollar I cannot give to my shareholders.
It's a direct zero-sum game in that sense.
Yeah. But in a mutual company, the person filing the claim is literally one of the owners.
Yes. Because the claimant is also an owner, mutuals often construct their entire brand identity around customer service, policyholder satisfaction, and long-term retention.
They want to keep you happy.
They want you to renew your policy for 30 consecutive years. When a mutual adjuster evaluates a claim, the corporate philosophy generally views that payment not as a tragic loss of shareholder profit, but as the fulfillment of their core operational promise to a member of their own organization.
Here's where it gets really interesting to me. It sounds like a beautifully closed-loop ecosystem.
It really is.
The better the mutual company does at avoiding bad risks, and the more efficient it is at handling claims, the better it is for the customer's wallet.
Because there's no middleman.
Exactly.
Yeah.
There is no middleman investor skimming the profits off the top. The money just stays in the loop, circulating between the members in the company.
And that closed-loop ecosystem is the exact mechanism that makes the mutual model so historically resilient. It is the reason why some of the oldest, most financially fortified insurers in the United States operate under this exact structure. But yeah, there's always a but. That closed loop also generates one of the most severe operational vulnerabilities a mutual company will ever face.
The catch.
Yeah.
I knew it. There's always a catch when something sounds too perfect.
Yeah.
What is the fatal flaw in the mutual model?
It's the capital problem. We have to look at how a business survives a true worst-case scenario.
Okay, like a massive disaster.
Yeah. Think about a standard stock corporation. Let's say they want to fund a massive technological expansion. Or worse, they suffer a historic financial hit, like a catastrophic hurricane season that just drains their reserves.
They need cash fast.
Right. A stock company can immediately go to the global financial markets. They can issue millions of new shares of stock and raise $1 billion in capital almost overnight. Investors hand over cash, and in return, the investors get newly created ownership shares.
But a mutual company is totally locked out of that strategy
Completely.
because they literally don't have stock to issue. The only way for them to add a new owner and get new money is to sell another insurance policy.
Which is slow.
And selling a new policy doesn't just bring in cash, it adds a brand new liability to their books.
Exactly. You hit the nail on the head.
They can't just hit a button and generate $1 billion of equity from Wall Street.
They're completely isolated from the equity markets. So because they cannot issue stock, maintaining an adequate surplus becomes a matter of life and death.
Surplus.
Yes. Surplus is the financial cushion of assets a company holds over its liabilities. Think of it as a massive, heavily guarded financial shock absorber that guarantees their solvency.
Their safety net.
For a mutual company, surplus is everything. It is their only safety net. They have to patiently retain a small portion of earnings over decades, sometimes even centuries, to build up a surplus large enough to withstand a once-in-a-century catastrophic event.
Wow. That puts their conservative nature into a whole new perspective.
Hasn't it?
They had to be financially conservative because they are their own backup plan. If the vault is empty, nobody is coming to save them.
Exactly. Nobody is coming.
But considering they are structured so differently from stock companies and they don't have shareholders to answer to, how do industry gatekeepers handle them? Like, are they playing by a looser set of rules when it comes to government regulation?
You might actually assume they get special treatment because of the cooperative structure, but the reality is quite strict. Mutuals are regulated exactly like stock insurers.
No free passes.
None at all. The oversight bodies, specifically state insurance departments and the National Association of Insurance Commissioners, or the NAIC, they do not care if you are owned by shareholders or policyholders.
Interesting.
Your fundamental obligation is to remain solvent and protect the public. The NAIC enforces this using something called risk-based capital, or RBC.
Okay, let's make sure we don't gloss over that jargon. For someone new to the industry listening to this, what exactly is an RBC standard?
Sure. Think of risk-based capital as a government-mandated financial stress test. The regulators look at all the specific risks a company is taking, like how many coastal hurricane policies they've written or how volatile their investment portfolio is. And they use a complex formula to dictate exactly how much cash that specific company must keep in their surplus vault to stay legally solvent.
So it's customized to their actual risk.
Exactly. And mutuals must pass this RBC stress test just as rigorously as stock companies. The co-op structure doesn't buy you any leniency with the law.
Okay, let's ground all these mechanics in a real-world scenario from our sources. Take State Farm, right?
A classic example.
One of the most recognizable mutual companies on the planet. Suppose they have an absolute banner year. The weather is incredibly mild, so claims are way down, their investment portfolio yields fantastic returns, and their internal operating expenses are perfectly optimized.
A dream year.
Right, they're sitting on a mountain of excess earnings. Now, in a stock company, the CEO declares a massive dividend and wires that money to Wall Street investors.
Champagne all around.
Exactly. But since State Farm doesn't have shareholders, where does the money go? My first thought is they just take all that excess cash and lock it in the surplus vault to build an even bigger shock absorber.
And strengthening that financial surplus is absolutely option one. As we just discussed regarding their isolation from the equity markets, pouring that excess money into the surplus cushion makes the company incredibly secure against future disasters.
The bigger the vault, the safer the policyholders.
Exactly. But what if their RBC stress test shows that their surplus is already more than sufficient? They're already super safe. They have two other primary levers they can pull.
Okay, if the vault is already full, I would imagine option 2 is looking forward. They look at their data, realize they collected way more than they actually needed, and decide to just drop the price of admission. They reduce future premiums for the policyholders.
That is a very common strategy. By charging less for renewals the following year, they directly align with their core mission of providing insurance at a reasonable cost.
And people love a cheaper bill.
They do. From a business perspective, reducing premiums is an incredibly powerful customer retention tool. It keeps the policyholders loyal to the closed-loop ecosystem. But there is a third option, one that gets a lot of attention.
Option 3. They just cut a check.
Yep.
They declare a policyholder dividend. They take a portion of that excess surplus and distribute it directly back to the eligible members who own the company.
And that mechanism returning capital directly to the policyholder brings us to a really critical junction for anyone listening who is actively studying for their professional designations.
The exams.
Yes. Because these financial mechanics dictate a company's survival, it makes total sense why industry gatekeepers are obsessed with testing this knowledge.
So for our listeners tackling your CPCU exams, how is this tension between structure and survival actually tested? Like, where is this going to show up?
You'll see this concept heavily tested in CPCU 500, which covers managing evolving risks, and in CPCU 520, which focuses on insurance operations.
Okay, 500 and 500.
Right. It is also foundational in the AIAF, the Associate in Insurance Accounting and Finance, and practically any module dealing with corporate governance. The examiners need to know that you intimately understand how the financial levers of a mutual company differ from a stock company.
And our sources highlight a massive trap here, a specific pitfall that test writers love to use to trick candidates into second-guessing themselves.
Oh, it is the ultimate exam trap. And candidates fall for it constantly because of the terminology. Do not, under any circumstances, confuse a policyholder dividend with a claim payment.
Okay, wait, let's slow down.
Yeah, they sound similar because they both involve the insurance company sending money to the customer, but legally, structurally, and financially, they're completely different animals.
Let's break the trap down so nobody misses this point. If I get a dividend check in the mail from my mutual insurance company, that money has absolutely nothing to do with my insurance coverage itself.
Correct.
It doesn't mean I filed a claim, and it doesn't mean my policy covers something special.
Exactly. The distinction comes down to contractual obligation versus discretionary distribution.
Contractual versus discretionary.
Right. A claim payment is a legal contract. If your house catches fire and you have a valid policy, the company is legally required to pay that claim based on the terms of your contract. They have no choice.
They have to pay it.
They have to. A policyholder dividend, however, is strictly a discretionary bonus. It is a distribution of excess surplus that only happens when the company performs exceptionally well.
So it's like a cherry on top.
Exactly. It is never guaranteed, and it is entirely separate from the insurance product you purchased.
So if the mutual company suffers a terrible year like multiple hurricanes, plummeting investment markets, they are still legally required to pay my fire claim.
Yes, absolutely.
But the board of directors is definitely not going to authorize a dividend check that year because there is no excess surplus to distribute.
Precisely. The dividend is a perk of the ownership structure, not a guarantee of the insurance contract. Exam questions will deliberately try to blur this line. They will present a scenario and try to trick you into treating a dividend like a guaranteed liability. Always keep the company's financial performance separate from its contractual claims obligations in your mind.
That is such a good tip.
Yeah.
So what does this all mean for you as you close the books for the day? Let's distill everything we've unpacked into a rapid-fire summary.
Let's do it.
If you only remember 4 golden rules from this entire deep dive about the mutual insurance structure, here is what you really need to lock in. Rule number 1, the owner. Who holds the power?
The policyholders.
Right, the policyholders. Rule number 2, the investors.
Yeah.
Who are the outside investors demanding quarterly profits?
There are none.
0. None. Rule number 3, the purpose. The fundamental operational goal is to serve the policyholders and maintain long-term stability, not to maximize short-term shareholder profits.
Serve the members.
Exactly. And rule number 4, the benefit. When the mutual company performs exceptionally well and the surplus is full, eligible policyholders may receive dividends, but those dividends are a discretionary bonus. They are never a guarantee.
If you can internalize those 4 rules, you will have a rock-solid understanding of how mutual companies navigate the market.
It really clarifies the whole system.
It does. But, before we wrap up, I want to leave you with a thought experiment.
I love these.
It builds on the mechanics we've explored, and it is something you should deeply consider as you advance in your insurance studies. We just spent this entire session discussing how this closed-loop cooperative system is brilliantly designed for stability, long-term pricing, and customer benefit.
Right, the 50-year game.
Exactly.
Yeah.
Yet there is a very real, very complex phenomenon in the industry known as demutualization.
Demutualization.
Yeah.
This is the process where a mutual company deliberately decides to convert itself into a stock company. Like, they voluntarily blow up the co-op model and transition to a shareholder-owned structure.
And it happens more often than you might think. A company that has operated for 100 years as a mutual suddenly files the paperwork to become a stock corporation.
Wow.
The question you need to explore is why? If the mutual structure is so uniquely beneficial for customer loyalty and unshakable stability, what kind of extreme internal pressure would drive a company's leadership to abandon it?
Oh, it brings us right back to the capital problem, doesn't it?
It is the ultimate collision between the desire for safety and the aggressive need for growth.
Tell me more.
Well, imagine a highly successful mutual company. They want to completely modernize their technology infrastructure, or maybe they want to acquire a struggling competitor to expand into a new country.
Big, expensive moves.
Very expensive. They look at their surplus vault, the pennies they've saved over a century, and realize it just isn't enough to fund this massive ambition.
Oh, man.
Then they look at Wall Street. They see billions of dollars in equity capital just sitting there, completely inaccessible to them because of their mutual structure. The temptation becomes overwhelming.
That is such a fascinating tension to chew on. Why leave the safety of the co-op? Right? Going back to our coffee shop at the very beginning. Imagine that barista not only tells you that you own the place, but a few years later tells you they are taking your ownership away so they can sell shares to a massive hedge fund in New York.
It's a huge shift.
It's wild. Understanding the mechanics behind why a company makes that pivot, the regulatory hurdles they have to clear to do it, and who actually wins in that scenario is exactly the kind of complex dynamic that makes the insurance industry so endlessly fascinating.
Absolutely.
Keep digging into those mechanics, keep questioning the financial structures around you, and happy studying.